Good afternoon.
Thank you for joining us today on this webinar. As you know, we'll be talking about IOCs, International Oil Company. I hope you are all doing all right. First information on that webinar actually is the date for the following one. The date is already blocked. You will receive the invitation after this webinar. It will be, let's say, quite soon. End of June, we will have this webinar. You will receive always, like as usual, the slides of today's webinar. So don't bother taking a screenshot. You will have all the materials, and you will also receive everything that you need. The link also to this video if you need to review it. Moving to the agenda is quite straightforward. We'll have a first introduction of IOCs and let's say their common profiles, and then we will look more into the details in their market footprint and their particularities. And finally, we will have a review of each of them. Obviously, it will not be a complete review for each IOCs, else we will be here until dinner tonight. So if you have any questions, don't hesitate to ask them in the chat. We'll answer them at the end of the presentation. I believe you all know us. We didn't change, so we can skip that quite quickly. Our scope of projects did not change. We still cover energy, and we are talking energy. Most of the people are talking about or thinking about oil and gas. And when you think about oil and gas, you think about the super majors, the international companies. And Jean, the floor is yours to have a first explanation, first introduction, and first characteristics of these companies.
Thank you, Jack, and thank you everyone for joining. In fact, behind IOCs, it's a term we use quite often, and it's also a category that is inside our database that is used to filter projects. In fact, in our own definition, I know we can discuss it, but we have put in international companies 6 companies. 3 US one, ExxonMobil, of course, Chevron and Conoco, and 3 European companies, being BP, Total Energy, and Shell. Some of you might add other companies, might retrieve others, but okay. For today exercise, that's what we will consider being international companies. And then normally your first question should be, okay, but why? What is the definition behind? And here we made this graph with a brief definition, I would say, of IOCs. First, IOC is the acronym of International Oil Company. Okay, so far so good. Normally, it's only oil and gas companies, I would say, which are privately owned to many shareholders and which operate globally. For us, those companies are quite specific because they share, I would say, some aspect that other companies don't have. First, most of them, and not, I mean, all of them have large engineering capacities. Okay, they have experts, they have verticals with people and strong expertise in every product line, every, I would say, type of plant, etc., which is not the case of a lot of independent companies, for example, which are sometimes more specific to an application, and also to the national companies that sometimes don't have, I would say, this deep engineering background and staff inside the companies. Also, most of them are licensors, as they try to be at least. What is quite important with international company that they are, I would say, not specific to a niche. Okay, they are not dedicated to one vertical in terms of type of plants, so they don't do only FPSO or only LNG. There are companies that can operate from offshore to onshore, oil and gas to from oil, to gas. They can operate in, I would say, in energy transition as well. And same goes with the regions. Okay, those are companies that have a global footprint. We'll see in the detail with Jack. So it's completely global companies, which is not the case, for example, of a company like Aramco, which is completely massive, I would say even bigger than those IOCs. But Aramco, of course, is dedicated to Saudi Arabia. Okay. One important point, though, that those companies, Exxon, Total, Shell, BP, are highly exposed to the public. If you read the news, if you talk to the public, those companies are quite well known, often for the bad reason, I would say. But they are quite representative publicly to our industry, and that's why they are so important, of course. And they're also quite leader, not only I would say to the public, but in terms of technology. Most of the, I would say, high top-notch technology are developed by those people, are mastered by those people. For example, when you take a deep sea offshore, okay, most of the knowledge is inside those companies. A little bit of history. It would be brief, of course, but I would say from the origin, those companies are all around the same period, the late 80s to the beginning of the 90s, where in US we had Standard Oil starting the activity. In Europe, we had Royal Dutch Shell and, of course, British Petroleum starting to emerge to explore oil, of course, overseas, not only, I would say, in the local market. But a big shake-up was made in 1911 when Standard Oil, which was becoming quite an empire, let's be honest, was broken up by the US antitrust law in 34 companies. Some of them we know very much because Exxon was one part of Standard Oil, but Mobil was another part, Chevron was another part, and you had 30 other companies inside it. So let's imagine the size of that company at the time. And then there were two important periods and crunching period for those IOCs. The first period was the 40s and 60s, which was a little bit the golden age of those companies. At the time, they were called the Seven Sisters. So for the one in this call which have the more experience, of course, remember the time where you had Exxon, Mobil, Chevron, Gulf, Texaco, BP, and Shell, which were completely dominating the market, if not representing the entire market, to be honest. But then it shifted in the 70s due to two oil crises, a big shock from OPEC countries. And then from those oil shock, we start to see the emerging, the state-owned company, so what we call in Project Smart Explorer the nationally owned companies, Aramco, of course, ADNOC, etc., and a lot of different companies. And since then, the NOC have grown, of course, quite massively, while the IOCs remain quite active players on the market. Since the beginning of the century, I would say the majors, the IOCs, went through consolidation process. So Exxon and Mobil merged, Chevron acquired Texaco, BP acquired AMCO and Arco, and Total, for example, acquired also Petrofina and Elf and became Total and now Total Energy. More recently, those companies which were called the Seven Sisters, then the majors, are now called super major to represent the fact that they are so big today that they are waiting a lot on the market. And those companies are highly specific because they are, of course, listed companies. And you see the graph on the left where you see the market cap of those companies over the last 20 years. A lot of up and downs, to be honest. But the fact that they are listed is, of course, a big problematic for them. Because when you are this kind of companies, you invest on projects that takes, I would say, 5 years to be built, and then are in operation for 20 years for upstream project. But for investment, for example, in petrochem refineries, those projects are going to be in operation for sometimes 40, 50 years. Meaning that your vision of investment and spending and operation is really long term, 20, 40 years. While at the opposite, when you're, I would say, those companies and you answer to the market, you need to report on a quarterly basis. And here is quite a huge problematic for those companies because they are impacted. I mean, the decisions they take today will have impact, I would say, minimum in 5 years and will have impact during 20 years. But in 3 months, you need to report what have you done, etc., what are you earning. So there is quite a huge gap here in terms of timing inside those companies, which can sometimes be quite problematic. Also, what is quite important with those companies, and sometimes when you work on projects, you may not have this feeling, is that those companies, if we take the example of ExxonMobil, for example, the biggest one, you have portfolio of opportunities, meaning that in the meantime, Exxon might develop a feasibility study for, I don't know, let's say 10, 20 projects. Among those 10, 20 projects, they will pick only the best one. It doesn't mean that the project which have not been picked will be cancelled, will be forgotten. It's just that those projects might happen in the future. So it's always a rolling ball of opportunities with those companies where they just invest in a project which have the best chance for them to yield, I would say, some returns. That's, for example, the case a little bit today with US project, where if you're ExxonMobil and you need to do a project in US right now, with all the discussion around tariff, it's almost impossible to calculate the price of the project because the procurement will be impacted by tariff. So clearly, ExxonMobil today, as they cannot, even calculate a budget for a project, they are not going to take decision on US projects. So most of the FID will be postponed to the, I would say, the second part of the year, while at the opposite, they have no problem taking decision for project in Suriname or in Africa or in Asia Pacific. Also, at those those companies, are of course, I would say, listed, and they are highly exposed to their shareholders because they need to, I would say, go back to them, explain what they are doing, and of course, it always sparks public debate. We have in France Total Energy, and each time they organize a general assembly, you will always have people like Greenpeace coming, throwing paint to their headquarters, etc., etc. So you see, it's quite a touchy point situation. Of course, you don't have with Aramco because you don't see Greenpeace people going to Saudi Arabia to throw paint on the headquarters of the company. If you look at the market cap, clearly most of them have massively recovered from the COVID hit, which was a kind of an all-time low for some of them. And also what is quite interesting is the gap between the US valuation of the company and the European one, which are of course lagging behind. So it's a kind of a financial trauma sometimes for those companies, but it's quite a reality to be honest. You have been quite vocal on the last week for the people we had the chance to interact with to discuss the barrel price fluctuation impact on those companies, but all the companies. It seems that we are all going to a period where the barrel price is quite low, around $60, $65. Let's see where it stands. And here we took a graph where you see the net income earnings of those big companies in blue on the first quarter of 2024 and in red the first quarter of 2025. And all of them, the net income are going down. And in fact, when your IOC, NOC are independent, you are not reacting the same way to the fluctuation of the barrel price because more or less when you're a national company, which is the case for us of Equinor, for example, and here NI, you are just producing and you adapt your volume of production to manage, I would say, or ensure the stable revenue for your home country. So usually you are not so much impacted because your production price will always be below, I would say, the cost on the market. When you're an independent company, some of them are quite highly exposed if they go to the spot market, but it's not many of them. Most of the independent companies have long-term agreements because they need to back up their investment. That's the case, for example, we see a lot currently in LNG, where the project does not start if they have not sold about 70% of their capacity of LNG production. So in fact, usually those independent companies are not impacted by the price on the market of the barrel because they are in long-term agreement with people which are either going to produce electricity, going to produce plastic, gasoline, etc. So they are less impacted. The IOCs, in terms of categories, those majors are the ones which are, let's say, a little bit more impacted because the first thing that is happening is that their level of debt is remaining exactly the same because the investments are the same, but the opposite, their balance sheet is of course going down on the asset side because it's all managed through the price of the barrel in terms of evaluation, financial evaluation. So it's quite a problem sometimes because they end up in a situation where they don't have the capacity to take the loan. It's quite artificial, to be honest, but they don't have the capacity for 3 months to take the loan to invest in the next project, even though they are making a lot of money. If we drop in the figures, and you go in the detail of those net income and the quite sharp decrease for some of those companies, honestly, the biggest difference is not so much on the barrel price. Most of the difference is coming from the decreased revenue they got from their trading offices. Because Shell, Total, and for example, BP have a really strong trading commodities field, for example, in Geneva, in London, and in Houston. And of course, on the last 2 years, even 3 years, I would say, since the Russian war, I would say the price of gas and oil were going up and down almost every week. So all the traders were making a lot of money, which seems not to be the case anymore, I would say, in 2025. So if you look really in the detail of those figures, the biggest drop in the net income is coming mostly from the trading activities and not so much from the core activity of those companies, which is producing energy. Okay, so it needs to be a little bit balloon this price effect on those companies. At the opposite, if we look specifically on those IOCs and how much they are going to be impacted by the barrel price, I think it's quite important to remember that over the last 10 years, let's say, the barrel price has been almost the same amount of time below those $60 and above. Okay, so clearly on the last 3 years it has been quite crazy, the situation, and the barrel price was going up and down every morning. But if you look on more the long term, over the last 10 but even 25 years, $60 per barrel is a price which is somehow manageable. Okay, now all those companies are impacted. It really depends on 3 criteria. First criteria is the balance between upstream and downstream. The IOCs which are concentrated on upstream, like BP, Chevron, Conoco, and Shell, of course, are more exposed because they are going to sell a lot of volume of their production to the spot market at the barrel price. So if the barrel price goes down, it means that their revenue for the next 3 months is coming down. At the opposite, if you are companies like ExxonMobil and Total Energy, which have kept quite a big part of downstream activities, I mean, the barrel you are going to produce doesn't go through the spot market. Okay, you pass it to your downstream activities, and then at the end, it's quite transparent to you, so you are less exposed to this barrel price, and that's why we see in terms of activities, ExxonMobil and Total Energy being less impacted by the barrel price today. The second criteria is a geography. It's a little bit less known, I would say, but in fact there is only 2 markets where the oil is produced, in US and UK, where the barrel is sold directly to the spot market. Okay, if you take other countries, for example, in Middle East, or if you take Norway, or if you take even Africa, most of the revenue from the international company are based on production sharing agreement. That's the case, for example, of Total, with many projects in Africa, where in fact Total is the main operator of a project, but they are paid through this PSA, production sharing agreement, $10 or $20 per barrel. And then the rest of the money goes to the country, to the national company they are partnering with. Meaning that even if the oil price going up and down, turning around, it's a fixed cost, it's a fixed revenue, for Total Energy to be producing oil in this market. Okay, and there is only 2 geography where it's really, I would say, the free market deciding on the price of revenue. It's only US and UK. So if you are less present in those areas, of course, you are less exposed to the barrel price. And the last criteria, which is maybe one of the more important one, and we are going to discuss it also a little bit later, is that for many projects, the IOCs are either operator or they are part of the joint venture. And of course, it's not exactly the same situation if you are operator of all your project, because then you are the one deciding for the final investment decision, and you are the one deciding on the timing of your project. And when you are a stakeholder, because when you are a stakeholder like Shell is a lot on projects, then you are going to follow the final investment decision from another company. And you don't really have the choice of the timing for this FID, because if, for example, Qatar Energy or Aramco is taking a final investment decision, then you have to put the money on the table to follow follow on this FID. And if you don't want to do it, then you need to resell your shares in the project, but usually you are going to lose a lot of money. So meaning that for many projects or many projects of those IOCs, whatever is happening to the barrel price, they're not the one deciding to invest or not. It's made by other companies which are less impacted by the price of the barrel. Okay, so that's why we see the NOCs pursuing their investment strategy, especially OPEC, for example, and then the IOCs, which are in those joint ventures, need to follow on those projects. Now, where this is going in terms of market footprint. As we said, those companies, international companies, have gone up and down along the years. And here we try to took along the years. So you see, we made, I would say, an export every 2 years since 2014 to 2024 to calculate their market share in terms of total project capex being invested and their volume of capex. And what is quite interesting that on the last 10 years, we had two big hits for those, I would say, international companies. The first hit was the drop of the barrel price in 2014. Okay, that you can see really having impact, I would say, mostly later, so meaning in 2026. 2016, sorry, where they passed from 20% market share to only 12, and of course from a capex of 50 billion to 38. And then there is a second hit because it recovered, I would say, arriving around COVID, but around COVID, second hit happened on the market. And here again, the market share went from 19% to 11%. And you see the capex was still dropping, not as much, but dropping quite interesting. But then if you compare it to 2024, you see quite a massive recovery because we are going back to this level of 20%, I would say, even if we're not there. But in terms of capex, you see they were last year at 100 billion, which was just double what it was 2 years ago, but also double what it was in 2014. So it's quite interesting to see the IOCs taking huge hit from the market as soon as you have I would say, strong dynamic happening, like COVID or the war. And at the opposite, they are always flexible enough and agile enough to come back and rebuild their market share. Honestly, if we look a little bit, I would say more in the past, over the last 30 years, the IOCs became less dominant of the market. Okay, we're talking about the Seven Sisters in the 60s, but honestly, in the last 30 years, they passed from 50% of the market to this market share of 20%. So of course, they are less dominant. Okay, they are less representative of the market, but they are still able to maintain this market share. And what is quite interesting is that the dynamic for them was to be kind of, I would say, gods on the market, to decide everything, to pick their suppliers, to pick their engineering companies. And today, and even more, I would say, on the last 18 months, we start to see them having more and more problematic and difficulties on the supply chain as all the other operators, I would say, not only them, but being less maybe acting like gods and being more pragmatic about their approach, building up partnership on the market, changing a little bit their procurement approach to be sure that they can be still served by the market, because today there is plenty of customers and plenty of operators that are also sometimes way bigger than these international companies. In terms of forecast, this market share for the future, so 2025 and till 2028, the market share of those IOCs is remaining at 17%. Okay, so you see it's building up and it is quite pragmatic. It represents 130 projects in total for the next 3-4 years, and it represents already, from what we see in the database and we have qualified, 374 billion US dollar. So you see this space of 100 billion being invested per year is more or less realistic to what we have in the pipeline for the next years. And inside this pipeline, what is quite interesting is that 1/3 is LNG train. So you see clearly a huge shift toward gas application. 1/3 is offshore and hydrogen. Offshore being still windmill, but going down, but mostly FPSOs, of course, and offshore platform, okay, which are massive scope of investment, and hydrogen being green hydrogen, green ammonia, and all this kind of application. And then 1/3 is all the rest of application. It can be pipeline, it can be e-fuel, it can be a lot of different pragmatic, but it's really 3 blocks of capex which are being invested, with LNG being at the top. Here we are talking about what are the projects being made by IOCs, where IOCs are the main operator. But as we discussed a little bit earlier, those IOCs companies are present in a lot of joint ventures. And if we take the figures not only for where they are main operators, but where they are active in the joint ventures, here I would say it grows a little bit. It grows to 30% of the market share, so it almost double, I would say, their footprint on the market. It almost also double the project, and it less than double the capex, but at the end of the day, it's still representing and having impact and influence about 662 billions of investment over the next 3-4 years, which is completely massive. The ratio behind those figures of capex or project also shows how much those joint ventures kind of consume their capacity of investment. Because, of course, as they need those IOCs to follow on all those joint ventures investments, sometime, and it might be the case in 2025, all their borrowing capacity is consumed by the project where they're in joint ventures. So then they don't have really the capacity to do all the projects they were supposed to do in their own name. Okay, so it's quite interesting to see how much it's going to play a role in the coming months, but it's going to be definitely a dynamic that we need to really look in the details. In terms of capex now, you see from the categories of capex that the blue part, which is the oil and gas part, is still maintaining, if not even increasing. Okay, that was a big question mark, and you see there were quite a drop in 2020 and 2021 of this oil and gas part, because at the time people were not sure if oil and gas would remain in the long term. But now, as you can see from the investment, oil and gas is remaining quite a big part, and a big part for the many coming years. While at the opposite, the petrochem is a bit small for this category. You might remember in 2014 where all the IOCs were kind of selling, or most of them were selling their petrochem and downstream activities to other companies, like BP sold their downstream activities to Ineos, for example. So that's why petrochem is not coming back so much, is because those companies are not so active into this market. What is quite a bit more, I would say, interesting is the energy transition. You see this green part, boom, it makes a huge step in 2020. And then 2021, not sure, and now we're starting to see a kind of a lean increase in energy transition. And while they were really pioneers in 2020 to make investment in this market, we see that it's clearly taking some traction in their portfolio, while also you see that it's not replacing other activities. Okay, clearly it's coming, I would say, on top of it. It's an addition like we see overall on the market. But what is quite interesting is to see that those IOCs weight about 25% of all energy transition. Okay, and here is something that might not reach really the public eyes, but when they are the first, sometimes culprit of any of carbon footprint, etc., etc., those same companies are also the, I would say, best actors in class to invest in energy transition. And here, those IOCs in the energy transition, we have seen, I would say, some shift back and forth. If we take the total capex, you see it's quite a steady increase, and we see it increasing till 2027. If it goes down in 2028, it doesn't mean they're stopping their investments. It's just that we don't know yet all the projects for 2028. Okay, but what is quite clear is that they are steadily increasing their investment, and today, I mean, in 2025, is going to be around 40 billions. Okay, so it's quite a lot of money on the table to be invested. And what is quite interesting that it all started in 2020, clearly. And originally, it was mostly the European IOCs, so BP, Shell, and Total, which took a sharp turn toward energy transition, and especially renewables. You might remember at the time when BP announced they were becoming beyond petroleum. Okay, it was a little bit too ambitious, but clearly at the time they were quite aggressive in going that direction, while at the opposite, the communication from the companies in US were a little bit say, okay, let's chill, let's look it, evaluate it, and let's see how we need to play that role. ExxonMobil at the time was quite critical, especially around renewables. And what is quite interesting that today those companies are a little bit shifting. Clearly, all the IOCs are less active in renewables because they started to realize that those projects first, if you take renewables like solar and wind application, you don't have operation. So when you're an operator and there is no operation, it's a bit counterintuitive, of course. And also they realized that their best capacity and their best expertise was to run complex projects where you had complexity from the financing, from the supply chain, from the engineering side, etc. And at the opposite, those renewable projects were quite not easy, because they're not definitely easy, but where in terms of engineering, supply chain, were quite more simple. And in fact, the weight of those capacities of companies was too much to be really profitable in this market. And that's why we started to see, I would say 2 years ago, the IOCs taking a step from renewable and say, hey guys, we are going to put money on the table, but we are not the right actor to do it. And that's why they started to pour money into this market through other companies. You had Total Energy, for example, creating SAFT for all the solar project. They are also using Adani, the Indian company, to manage this kind of project. ExxonMobil is doing it through other companies, BP through Lightsource, for example, etc., etc. What is quite interesting also is that the US companies are now becoming super active in energy transition, meaning not only renewable, but also what they call the low carbon or decarbonation, so all the carbon capture, e-fuel, hydrogen projects. So it's becoming quite a big chunk of those IOCs. And for example, in 2025, Exxon is going to overtake Shell and BP into this low carbon spending. Okay, so even if the US companies were quite, I would say, looking at it from far at the beginning of 2020, those are super active in this market. And honestly, it's quite a natural growth to go to carbon capture, to go to hydrogen, to go to e-fuel, because in terms of expertise and technicality, it's a flow process. You are producing energy, you have a fluid or a gas to manage, etc. So in terms of expertise, it's quite natural to go in those markets. And that's why we see them really having a strong increase in hydrogen, in CCUS, in alternative fuels, SAF, e-fuel, biofuel, whatever fuel you can invent. Also, I mean, because it's quite their expertise, but they are also, I would say, developing their own market. Because if you look at the market of hydrogen today, who is the biggest consumer of hydrogen on the market? It's refineries. So clearly, they are producing their own hydrogen to sometimes trying to decrease their own carbon footprint. So it's quite natural for them to go on those markets and to start also to develop a market to do it for others, for the cement industry, for the steel industry, etc., etc. So it becomes quite an opportunity for them to decarbonate themselves, but also to decarbonate other industries. Okay, so it's quite also important to keep in mind. In terms of region, IOCs are quite international companies. Of course, it's in the name. And what is quite interesting that if you look at here on the top right corner, the region where they operate the project, you'll see that the top region is Africa. In fact, and the second one will be North America or Asia Pacific. And in fact, if you look at the overall database, it's a bit different because Middle East weight way more, for example. But in fact, the IOCs, sometimes they don't have access to the field anymore. For example, in Middle East, today, Aramco, ADNOC are the main operator of the field on the region, and they don't really need to have a BP or an ExxonMobil to be the main operator of those projects. So that's why the footprint of IOCs is well impacted by their access to the field, and that's why Africa, Asia, and North America remain important because either they don't have, I would say, national competitors, I would say, in the region to develop the field, or because of free market, you don't have also a national company to compete against them in North America, especially. So it's really driving for them the market, the access they can have to developing those new fields. In terms of engineering, you see that 2/3 of the feed are remaining in Europe and in Houston. Because I mean, most of the engineering capacity for feed in North America is in Houston, so that's why we take a shortcut to say most of the feed are in Europe and in US. The reason behind is that because they want the best technology in the first design, clearly, and they want to have some innovation. They want to have digital twin, as we can see today, and they want to have design, for example, which are reducing the carbon footprint of operation, and they are really moving toward this goal. While at the opposite, at EPC stage, we see a lot of projects going to Asia Pacific, because of either capacity of engineering, but also sometimes quite often for a question of price, because during the execution, those IOCs having, I would say, big engineering department can master the technical part while reducing the price really at the EPC contract using, I would say, cheaper engineering hours in India, for example, or in Singapore, etc. One point also which is worth mentioning, the little engineering support they are having from Middle East. If you take the global map for all the companies, Middle East start to wait quite a lot in terms of engineering capacities, but in fact it's Middle East engineering done for local content for projects which are also in Middle East. And while we were saying that IOCs don't have access to those fields in Middle East so much, of course they are less using those engineering capacities because they don't have local content issues, I would say. So that's why also it's playing a different role than if you're looking other type of companies as well. Now passing the ball to Jack for some details on companies.
Thank you, Jean, for this explanation and this background on these companies. Let's have a look at them one by one. Again, not into all the details, but some, let's say, key elements. Let's start with ExxonMobil, which is, let's say, the biggest of all the six. Depends what you look at, obviously, but if you look at the market cap, it's by far the biggest of the six company. We also put the volume of oil and LNG production for each of them and their barrel, let's say their profit and net income per barrel. And here for Exxon, it's let's say the best of all the six. They make more than $20 per barrel. Here we assumed a barrel price of $65. So you can imagine that even if the barrel drops to $50 dramatically, it will not be a drama for them. I'm sure they will prefer the barrel to go at 70 than to drop at 50, but they will not close the shop for such a reason. Now, if you look at Exxon, they have a particular, let's say, appetite for FPSO. They even announced a few months ago an agreement with BW to have a standardized FPSO because they are in actual need for with this.
SBM, Jack, sorry.
SBM, sorry. Yeah. My bad, with SBM. And if you look on the next slide on the, let's say, country mix, you can see that they are quite dependent now from Africa. Just to provide a bit of background, the weight of Africa in their investment is even bigger than the situation for Total, which is historically quite important in Africa. For all of them, we also put you the names of, let's say, the top 5 engineering companies doing their FEED. Here we only consider the projects for which the super majors are operators and not when they are stakeholders. And for all of them, you will see that in the top 5 there is their own name, and that's to put in perspective what Jean explained before. And super major, one of their characteristics is to have the capacity to have say engineering capacity to do their own studies. And you can see SBM and not BW in this top 5. Moving to Chevron, here also Chevron quite an appetite for offshore application. Just a particularity of Chevron is there. Let's say they are involved in 6 CCUS projects. If you have been to our first webinar in 2025, we had a special point on CCUS. Currently, these projects have, let's say, some issue moving forward due to financial structure of this program. Let's see how it evolves for them for these key 6 projects for Chevron. Looking at their also that exposure in terms of region mix. If we can move to the next slide, Jean. Bit of a delay. Here we are. Here again, for Chevron, it's benefiting from the push there is currently in Africa. That's something that we'll have for almost everybody. Knowing that traditionally Chevron was more present into Asia, but with the projects they currently have in the portfolio in Africa, the mix is a bit changing for them. If we look at the third and the last American super major, Conoco. Interestingly, we see a huge push in the coming years in terms of pipeline of projects compared to what they have in the past. We are talking about a multiplication by something 3 and 4. This is mainly driven by 2 projects. Port Arthur in US, and especially Northfield in Qatar. And that's actually changing quite the game for them, and it's completely driving, let's say, consuming all their capacities. If you look at their country mix, they are mainly present for 60% of the projects in Middle East because of these huge projects that they have, obviously. Now, if we start to look at the European ones, and the first one on the list is BP. Let's say that currently for BP, it's not the brightest times ever. It's quite difficult for them for quite a long time now. The market cap is one of the lowest. Just a quick reminder, it was 3 times this amount 15 years ago. And more, let's say, more importantly, the profit they do per barrel when the barrel is at $65 is just above the dollar. So if the barrel price tries to drop significantly at $60 for a long time, they will start to burn massive amounts of cash flow, and that will be a problem. I'm not going to explain all the reasons why we are at this amount, but one thing that is for sure not helping is what we see in the graph, their exposure to energy transition, not because it's energy transition, but mainly because, let's say, it's not the right color of green. They are massively invested in windmills. We know that these projects are not making any profit, and that's absolutely not helping BP, their exposure, and lead to, let's say, a reset of their strategy, a strategy that they call a reset. Basically, it means they will need to build back profit, and this goes through oil and gas. They have wonderful people in the marketing, so they call that resilient hydrocarbons, but that's still oil and gas at the end of the day. And if we look at their, let's say, their country mix or region mix, traditionally they are quite present in US, and now that we see that a big part of the chart is eaten by Asia Pacific. Again, that's a consequence of the project they have especially in Australia with the huge windmill projects. That's why their share both in US and also in Middle East dropped quite drastically. If we look at the Dutch one, Shell, two particularities of Shell. First, they also involved at the beginning in windmills. I think they made quite a quick move out of it. But now they are mainly active in a carbon capture application, whether it's on a cement plant or directly on blue hydrogen, blue ammonia, blue methanol. They develop their own license with that. So that's their strategy in terms of energy transition. It's really to go on these carbon capture applications. Second particularity of Shell is that they tend to be more stakeholders than sole operators. 75% of the project they are in, they are not the sole operator. They are only in JVs, and that's the clear impact for them in the country mix. Is that they have a country mix that is quite, let's say, harmonized throughout the regions. Bit of delay here in the slide. Yeah, it's coming. So they are operating a bit everywhere on the planet. Again, they are benefiting from this push in Africa, which is gaining a bit of momentum currently, but their let's say exposure is quite balanced. If we look at the last one, an interesting one, and I'm not saying that because I'm French, Total Energy is quite interesting because if you look at first at their profit per barrel, it's the second biggest of all the super major. Only Exxon is doing better. We're talking $80 a barrel. And if you look also at the size of the company, just a key information, there is twice more people working in Total than in ExxonMobil. But when you look at the market cap of Total, it's something like 25% or 30% of what Exxon is worth. So when you recently have Mr. Pouyanné explaining that he wants to go on another stock exchange market, when I see the figures, I can understand a part of it. But that's always been the game, I believe, in France. But if you look at the pipeline of Total, it's quite impressive. First, their strategy is quite clear since 2020, especially with the energy transition. Quite quickly, they made the move, especially with SAFT, as Jean explained, on solar projects. And they clearly said that they are not going to stop oil and gas. And you can see in the investment in oil and gas are growing, especially in gas. They are currently having foot in a lot of LNG train projects. totalizing more than 100 billion when Total is involved in these projects. So they are quite active on the market now, Total. The country mix of Total, region mix of Total, without a surprise, highly dependent from Africa, first for historical reason, and then again for current, or let's say current reason today with the attract that we have in Africa. One word on the LNG project that currently has been awarded after, let's say, quite some movements over the last years. The FID is expected in the next 2 quarters, let's say, depending on, again, when is the ideal time for them to take the decision investment, as Jean explained at the beginning. One last thing before going to the conclusion, you saw, well, you will be able to see it again when you receive the slide. You will have the volume production for each of these super majors. And if you sum them up, you will land something around 9.4 million barrels per day. Just to put a bit of perspective behind this number, Aramco has the capacity to produce 12 million barrels per day, and in total, we produce 103 million barrels per day of oil. So to put a bit of perspective with what John said at the beginning, that they do hard face of oil and gas for, let's say, everybody's that knows them. In the reality, you see that now they only weigh something like 9% of the oil production globally, and altogether they can't even compete with Aramco's, both in terms of volume and not even talking about market cap. So just to let's say conclude on these IOC's profiles, to put a bit of perspective on what they represent to what they really are.
Thank you, Jack.
Floor is yours for the last conclusion, and then we will move to the Q&A. So if you have some specific question on some IOCs, feel free to shoot them.
Yeah. Thank you, Jack, for this detailed vision of those companies. So in fact, as we said, and that was a little bit the point of Jack, to say, hey, right now, with all the barrel price fluctuation, IOCs would be quite impacted. They will not be stopped, clearly. They will pursue taking FID, no problem. Some project might be delayed, but they will not be cancelled or stuff like that. But we invite you to rebalance, I would say, your opportunities between IOCs, those NOCs, and the independent companies. Honestly, the IOCs that will free their project are the ones which are the more exposed to the barrel price. So not so much Exxon, not so much Total. For example, maybe the others will be a little bit more delayed, I would say, to take their FID. The idea to clean up their balance sheet and reduce their volume of debt according to, I would say, the asset they have in front of them. But anyway, all those IOCs companies will still need to pursue their investment on projects where they are stakeholders. Okay, so you still see BP, Chevron, and Shell doing a lot of projects, maybe not on their own name, but in joint ventures that, of course, you can reuse your qualification to jump in. So that's why I would say 60% of the project overall of all those companies will happen, whatever is happening on the barrel price. And then on the 40% remaining, maybe half of it, so 20% of the scope, will be delayed, knowing that it will not be cancelled, it will only be delayed by a few months. Okay, keep in mind that they know how to operate at $60. Okay. No, overall, those IOC, honestly, they have regained their market share. Okay, they have absorbed the COVID, they have absorbed all the Ukrainian situation. They have also absorbed, I would say, all the mess around their strategy of energy transition. And what is quite interesting that they are pursuing long-term their vision on oil and gas to remain champion of oil and gas production and to keep doing it in I would say next decade, with LNG clearly being their first focus. Okay, that's 1/3 of their total investment. So clearly they see a big shift into it. That's all of the publication and communication they are doing as well. And then behind LNG, we see offshore coming again with FPSOs, offshore platform, a little bit of offshore wind, but just a little bit, to be honest. And at the opposite, we see as a second pillar coming decarbonation project. So clearly hydrogen, carbon capture project with, I would say, when they are announcing projects, those IOCs, a bit more, I would say, maturity than what we see from other actors of this decarbonation market, because usually those IOCs, when they announce projects, they tend to do it to materialize those projects, which might not be the case with all the independent actors we see in energy transition, which are announcing projects sometimes for the sake of raising money. Okay, those IOCs don't need to raise money, so they can do those projects quite interesting. In terms of region, Africa appears as a new El Dorado, clearly, mostly driven by the lack of access to other region, quite as open as they can do today in Africa. So that's why it concentrates quite a huge volume of business. Suriname, for example, Guyana can be other example of it, but to a smaller size, I would say. Overall, I would say all those IOCs are doing very well, except BP, which is, I would say, starting to rebound now and change strategy. But all those IOCs are doing very well. They are having quite a lean growth in terms of project pipeline, both in oil and gas and in energy transition. And what will be, I would say, the major risk for them today, but they are quite aware of it and they're starting to work on it and send signal about it, is that they are starting to become more and more attentive to their supply chain because they're having issues of bottleneck, and they know that they don't have the same dominance that they had before, so they are at risk, I would say, of the supply chain, and most of those companies are now starting to work quite actively to solve those issues.